Ladies and gentlemen, good day and welcome to the H1 FY26 earnings conference call hosted by NIS Management Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. I now hand the conference over to Mr. Charvin Zaveri from Share India Securities. Thank you, and over to you.
Thank you, and good afternoon, everyone. Congratulations on a very good set of numbers. On behalf of Share India Securities, I welcome you all to the H1 FY26 earnings conference call of NIS Management Limited. We are pleased to have with us the management team represented by Mr. Debajit Chaudhary, Managing Director, and Mr. Kanal Mukherjee, Chief Financial Officer. We will have the opening remarks from the management, followed by the Q&A session. Thank you, and over to you, sir.
Good afternoon, everyone. Thank you for joining us for our first call as a listed company. I truly appreciate your time and interest in our company's performance for the first half of financial year 2026. Since this is our first call, let me begin by briefly introducing our company. NIS Management Limited was founded in Kolkata in 1985 as a security and investigative services provider and became a corporate entity in 2006. Over the years, we have expanded the business into facility management, electronic security, and skill development. Today, we manage a workforce of around 17,000 personnel across 14 states, supported by a lean back-office team that oversee operations at more than 1,300 sites. Our clients include corporates, banks, hospitality groups, manufacturing units, healthcare institutions, public sector enterprises, airports, and retail companies. We also operate NIS Facility Management Services Private Limited, which provides electronic security solutions, and Kritika Academy Private Limited, which is an NSDC-recognized training partner. From a financial perspective, the first half of FY2026 has been encouraging. At the consolidated level, our total income stood at 214.89 crores of rupees, which reflects a year-on-year growth of 6.8%. Our EBITDA improved from 16.73 crores of rupees, representing a growth of 11.31%, and our EBITDA margin expanded to 7.79%, an improvement of 32 basis points. Our PAT increased to 10.22 crores, a growth of 12.5% on a year-on-year basis, and the PAT margin improved by 24 basis points to reach 4.76%. Our EPS for the period was 6.42, which represents a growth of 6.12%. At the standalone level, our total income for H1 FY 2026 was 204.69 crores of rupees, an increase of 8.36% year-on-year. Our standalone EBITDA grew strongly to 13.95 crore, reflecting a growth of 28.87%. EBITDA margin improved by 108 basis points to reach 6.81%. Our PAT increased significantly to 9.12 crores of rupees, which is a growth of 40.07% year-on-year. And PAT margin expanded by 101 basis points to reach 4.46%. EPS stood at 5.73 rupees, a year-on-year increase of 32.03%. We continue to prioritize integrated facility management contracts, which carry higher margins and are predominantly government-focused. With the Government of India continuing to increase spending on infrastructure, we see a strong pipeline of tenders that are well positioned to win and execute. Alongside this, we are also focusing on CCTV installation projects, which are again largely driven by government requirements. These two verticals, integrated facility management and CCTV installations, remain the primary margin drivers for the group, and I expect them to continue to play a central role in our strategy. On the corporate side, we are seeing steady client onboarding. More corporates are recognizing the value of specialist facility management services instead of informal cleaning and basic maintenance arrangements. This shift supports our business model and allows us to provide higher value services that improve margins. We are also seeing renewed activity in government-led skill development initiatives. We have applied for several contracts across different states and are awaiting the results. Geographical expansion continues to be a key priority for us. We are witnessing strong growth in Maharashtra and Gujarat, and I believe we will deepen our presence in these regions. Before I conclude, I would like to highlight the positive environment in our industry. The organized facility management sector in India is experiencing strong momentum and is expected to grow to nearly $61 billion by 2030, supported by steady outsourcing and increasing adoption of technology-enabled service models. The Indian video surveillance market is also expanding rapidly and is projected to rise from about $4.4 billion in 2025 to more than $7.1 billion by 2030, driven by smart city projects, higher security needs, and a wider use of digital and analytics-based solutions. These trends align directly with our strengths in integrated facility management and CCTV installations and place us in a favorable position to capture incremental opportunities and further strengthen our margin profile. With this, I would be happy to take your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take a first question from the line of Keshav Garg from Counter Cyclical PMS. Please go ahead.
Sir, so thank you very much for this opportunity. I wanted to understand, post the IPO, now what is the net debt on the company, and going forward, at what debt to equity ratio will you be comfortable?
I will advise our CFO to address this.
Sir, as per the financials, we currently have a debt of, at a standalone level, we currently have a debt of around 70 crores. And we've already, taking steps to reduce this debt. So most of the debt is, 90% of the debt is actually cash credit. And a very small amount, around 2 to 3 crores is actually long-term term loan based. So we are, we will obviously not increase the debt amount beyond what is the current levels. But and I think as on a year-on-year basis, as the revenue keeps increasing and the margins also keep improving, we should see our debt equity ratio going down considerably. And I think in the next 2 to 3 years, we should see our net, debt equity ratio reaching somewhere around 40%.
Right. So, and also in the balance sheet, I can see there is some 53 crore worth of short-term loans and advances. So what exactly is this?
These are actually into two parts. One is short-term loans, which we give as a part of our, IFM contracts and facility management contracts to vendors and employees, which is to the extent of around 7 crores. And around 47 crores pertains to balances with government authorities, specifically, tax authorities, and the TDS that we have all booked for this year, and couple of refunds for FY12, 13, 14, which are pending to be received, and balance of around 20-25 crores, which pertain to earlier years higher deduction by government contracts which were not deposited, and we are following up with them for deposit of the same.
So basically 47 crore is a huge amount. It's almost a quarter of our net worth. So basically, when will we get this money back? Because I can see as of... Yeah.
Sorry. Yeah, you can please complete, sir.
Yeah, so basically in March also this was 48 crores. So basically it seems that this amount has been blocked with the government since a long time. So will we get this money back, or it's nature of the business that this will continue to be so?
No, sir. I think this year it should go down by around 3 to 4 crores.
because we are already seeing certain tractions, in terms of receiving the money. And we believe that it should go down by around 3 to 4 crores, and I think in a couple of years this should come down significantly. The government is also being very proactive in terms of clearing these dues.
Right. Now, for FY26, what kind of top line on a consolidated basis should shareholders expect, and what kind of operating margins, EBITDA margins you think can be achieved?
I think at a revenue level, at a top line level, we are looking at a 10 to 12% growth. We believe that this growth will also be reflected at a PAT and a EBITDA level. I believe that the EBITDA margins should stay around 7.5% to 7.7%, and with at a consolidated level, and with PAT margins of around 4.5% to 4.8%.
Right. And for next year, any projections?
I think Mr. Chaudhary, our managing director, would like to take that question. Is it okay if I give it to him?
Yes, sure. Please.
Yes, sir. Actually, what we will see next year is that, although it is a little too early to say, but what we will see is that there have been several contracts which we have booked just very recently over the last month, and it is happening this month. In fact, significant growth has happened this month itself. And what we will see is that in 26, we will only get the benefit of, say, 3 or 4 months of these contracts. But in 27, we are going to see a significant growth in the total revenue position. And I would think that we would be expecting a revenue increase of about 20%.
Right. And what about margins? Will margins remain stable, increase or decrease?
Margins would also increase, and we are expecting the margins to again go along with the same percentage. We are not seeing much of constitution in margins right now.
Right. So now, one thing wanted to understand that where do we score in front of bigger players like, let's say, SIS? Is our basically the labor that we have or the people the staff that we offer in security, are we able to find them at a lower price from West Bengal, or is it let's say, how do we compare with SIS? Is our cost of staffing lower than them?
The few things are that, of course, we are expecting our cost of services to gradually come down, especially since we are integrating a lot of technology within our back office operations right now. So one thing is that we shall be doing that. And the second thing that is also very important is that although the labor cost does not really come down significantly because our contracts are generally guided by minimum wage contracts. So there will be a revision and it is equal for most agencies. But what is true, firstly, we are operating from a smaller base and with a high liquidity position for us right now. We should be able to take advantage of our expansion, as I've just mentioned, in different parts of India. And therefore, what we are looking at that we will see a significant higher percentage than possibly SIS, who generally I can say. And it is also very important for you will please kindly note is that we shall also possibly be getting a good advantage from PF offered ELI scheme, which is a very recent scheme, and we should push our EBITDA significantly, and the cost of wage will come down. So what we are going to see is we are going to see quite a bit of margin happening from these operations, and we should be able to position ourselves distinctly from the way SIS would project.
Right. And I can see the taxation in FY21 we were 33%, then 25, 24, 17, and last year 1%. I'm talking about the corporate tax. So going forward, and this H1 we were 5%. So can you tell us that on a consolidated basis, what will be the effective tax rate on us for FY26 as well as FY27?
Yeah, I will just advise Kanad to address that.
Sir, I'll take that question. So the effective tax rate is basically a function of 80JJAA. It's a deduction which is linked with the employment, and we have because of this benefit, we've been able to reduce the tax rates from 23, 24 onwards, and I think this we'll be able to sustain for quite a few years. So I don't think the effective tax rate, what you're seeing right now, I think that should continue because our business is primarily modeled on the adding number of people.
Yeah, sure. So last year it was 1%. In H1 it was 5%. So I mean, it should be in this range or closer to 1%, closer to 5%.
No, it'll be around 4 to 5%.
Okay. Okay, great. So, and for next year also, the same rate should be expected.
Yeah, 4 to 5%. Yeah, exactly.
Okay. Now, also, I can see that our EBITDA fell last year, and in fact, even our EBITDA is flattish since FY22. So basically, 4 years, FY22, our consolidated EBITDA was 26 crore, then 29, 32, and then last year again 27 crore. So what is the reason that despite revenues increasing, margins seem to be coming down every year?
Sir, this would one of the reasons. I think I'll give my answer and then I can pass on the question to Mr. Chaudhary and he can give you a more detailed answer. But one of the reasons for the EBITDA, coming down over the last couple of years is primarily it has to do with the fact that we were focusing more on the private sector contracts and slightly less on the government contracts. And that has obviously had, while it has had a benefit at the cash flow level, because if you see our consolidated cash flows have improved also during this period of time. The operating cash flows have improved during this period of time. It has taken its hit at the EBITDA level. But again, we believe that sustained growth and definitely sustained growth in margins happen at a government level. So we are again slowly focusing refocusing our priorities and focusing on contracts at a government level. I think Mr. Chaudhary can elaborate on that.
Sir, there are a few elements which are very important. One is that since we have been actively participating in all government tenders, etc., there are two aspects in government tenders for which we have to moderate our focus into that. The first aspect is, of course, that government contracts take a long gestation period. And so what it happens is that it will become slightly difficult for us to really estimate as to when are we going to get the contract in hand and can start operating on it. That is one particular problem. And the second problem is that usually government contracts, especially the state level government contracts, come with a very high PSO. So what we are focusing on is, while we will be keeping our focus on government contracts because there are good margins in it, but at the same time, we are trying to improve our corporate and our private sector contracts, which will help us to give us the advantage of cash flow. This is one. Regarding the increase in the EBITDA area, there are two aspects I would say that, as Kanad, as our CFO has just mentioned, that we will be calibrating our growth in the government sector to ensure that there are higher EBITDA margins coming from those contracts, especially by shifting our focus from pure security or pure cleaning contracts to more integrated facility management contracts. And we are also going to see possibly a much higher growth around the rental business in CCTV, which will help us to boost our EBITDA significantly. So we do look forward to going at a higher EBITDA.
So now, Mr. Chaudhary, our receivable seems to be really, really high. I mean, if we compare with SIS, their receivable days are hardly 50 days, and ours is like 2.5 times of their receivable days. So why exactly is this, and what are we doing to reduce this receivables? And also, what is the threat of bad receivables, which we might not be able to collect ultimately and will have to write off?
Sir, I will hand over to Kanad, but first I would like to say that we are not seeing significant bad debts happening. Okay? So receivables will be good for us, and Kanad will give you the details.
So basically, one of the features in our industry is that there are two things. One is our industry is an annuity-based. These are mostly annuity-based contracts. And the second part is that a lot of these contracts are old contracts. And when we started the contract, mostly, these contracts required us to invest around 3 months or 4 months. Earlier it was 4 months. Now it's actually come down to 3 months. 3 months of wages. And with that investment of the DSO would automatically, become 3.5 months. And, that has basically sustained over time. But what we are happy to kind of announce is that it has sustained over time, and over a period of time, we should be able to, bring it down. Earlier, we were very highly focused on government contracts. A lot of those government contracts are also retained by us, and therefore we don't see a lot of, any bad debt typically happening.
Right. So now, just if you could give us a brief overview of I can see we have 5 subsidiaries. One is NIS Facilities Management Service, that is self-explanatory, but if you could just give some more color that what exactly, because facility management is a huge segment, catering is there, gardening, cleaning. So what exactly are we doing over there? Are we focused on airports, let's say, for example, or private sector, or what exactly? And similarly, the other subsidiaries, if you could just give a brief overview of what exactly are we doing over there.
Sir, Devojit here. I will try to do that. First is, I would like to bring in one distinction from the name and the operations that we actually do in NIS Facility Management Services Private Limited. In NIS Facility Management Services Private Limited, although the name is Facility Management, mostly we are doing our electronic security operations, the SI operations from that. This is the first thing, sir. We actually do our facility management contracts in the main NIS Management Limited. The reason for this is that since all these are tender-based, and the credential acquired actually helps us to operate in a bigger and bigger contract size. And for that, what happens is that NIS continues to grow in the facility management space also. Because of its bigger size. And so first distinction is there, sir. Now, coming down to the subsidiaries, as I said, facility management company, NIS Facility Management Services Private Limited, is primarily centered around our SI activities and now gradually our CCTV installation and rental activities, and possibly more going ahead into more analytics-driven CCTV operations. Now, as we go into that, we will see a lot of turnover increase and margin increase, especially in the facility management space. The NIS Facility Management Services Private Limited space. What we are actually looking for is that it had traditionally given us a higher margin, and in future it will give us a significant higher margin from what we are operating with. So there is also another, the company, which is the Kirtika. Kirtika, actually, there are 2 firms. One is the Kirtika Academy Private Limited, and the other, which basically had been operating with government skill development initiatives. And there is another, which is the Kirtika Education and Associates LLP, which basically operates in the ITI space. In the Education and Associates one, we have 4 ITIs, and we are operating very strongly in those with a very high profit margin coming from that. But the size of the business is yet a very small business because ITI is a very niche operation, and especially the kind of PPP models that we operate with has been coming from the state government of West Bengal only. We are now looking at increasing our base of ITIs significantly in the coming years, and this will also give us a boost in the profitability because the profitability in ITIs is very high. In the academic space, there has been issues because of one fundamental reason, that is since COVID, the government spending on skill development had suffered very significantly. And therefore, new projects under the government, either the state government or the central government ministries, have been very low. This year, there is a promise of this whole thing changing. And as it changes, and we have started bidding for those new projects that are about to come. In 27, we expect a very high percentage of these projects coming to us directly. And this should improve the status of Kritika Academy Private Limited very, very much. I am very hopeful that Kritika Academy will do that. There is also another area which I think we should mention, is that Kritika Education and Associates had always been operating in an online mode since the COVID days, where we have been offering a lot of online training to different personnel. Over the last 2-3 years, this has also expanded into software technology training online, and we have had a very reasonable traction in that. And we have not really focused on a very solid growth as yet, but we hope that as more and more requirements for training in the advanced technologies, especially the AI technologies, ML technologies and such things, MUN stacks and others, as they increase, we shall also see a very significant growth in that area.
Sir, and what about the HV's Resolute Private Limited 51% subsidiary?
Activist Resolute is basically a very specific niche farm where we are doing a lot of experimentation in the AI and ML space. And we have not generated revenue in that. In going ahead, we are not going to see a very significant increase in this number. Possibly what would happen is that much of our AI ML initiatives will come over to the NIS facilities management space, where we are doing a lot of work in the systems integration and AI-driven cameras.
Right. So I hope all of these entities are profit-making.
Sir, I'll just take that question. Sir, Kritika Academy Private Limited had a loss of around 8 lakhs.
Okay, and this is 8 lakhs is for H1 or last year?
H1.
Okay, right.
Other than that, they're profit-making.
Okay, great. Thank you, Mr. Chaudhary, and best of luck to you.
Thank you very much, sir.
Thank you. We'll take our next question from the line of Mayank Saraf, an HNI investor. Please go ahead.
Hello, everyone. Am I audible?
Yes.
Yes, sir. Good afternoon to you.
Yeah, good afternoon, Mr. Chaudhary, and congratulations. I just wanted to know a couple of things. Firstly, what is the revenue percentage from government to PSU tenders, and what is the average tenure?
So, traditionally, our government percentage had been 48%, and the tenure is more than 5 years, 3 to 5 years always. But I think the average will work out to be 5 years because there are contracts which we are operating, large contracts which we are operating for more than 10 years, like the secretariat buildings in West Bengal and such places.
Okay. And currently, how much, what is the value of the bids that we have submitted for new tenders? That is under evaluation.
A tender that we operate in and we have credentials for in the manpower area, NIS Management Limited, they operate around, say, 5 to 25 crores annually. So traditionally, that is the bid size, and we are continuing to do that. And for the technology area, each of our bid would be something around from, say, 3 to 5 crores, and which could go even up to 10 to 14 crores. SI projects.
And what is the retention rate that we are seeing in the government contracts traditionally?
So as I said, it is very high because we are doing, say, an average of 7-8 years on these government contracts.
Okay. So secondly, now I'm coming to the electronic surveillance part.
Yes, sir.
So I just wanted to know, like, what is the value of tenders that we have won for CCTV specifically, and the current bid pipeline? Like, value of tenders that we have won and the current bidding pipeline for government CCTV projects.
So the exact figure, Kanad will be able to give you.
So I'll just take this question. So basically, so we have bid for current order book of this year is the current bid pipeline that we have is around 14 to 15 crores, with 2 tenders coming in the month of November itself. And I think by January we should have been able to bid on all of it. During the year we have booked revenue from during this entire year we'll be booking revenue from our rental contract amounting to around 7 crores, and we've already completed 3 orders from the Shama Prasad Mukherjee Port, which amounts to around 3.5 crores. And we have also won the order under the MP LAD fund, which amounts to around 2 crores. And we, like I said, will be bidding for another 14 crores worth of contracts between now November and January.
So this CCTV thing has a better EBITDA margin, I guess?
So the CCTV thing has significantly better EBITDA margin. There are there are 2 business models here. One is the OPEX model. The other is the CAPEX model. And when I say OPEX and CAPEX, I mean it from the customer's perspective. So one is where they buy the cameras and we only do supply, installation, testing and commissioning. So there we look at EBITDA margin of we look at a gross margin of around 15 to 20%. 20% is on an average, I mean, because large value contracts and these are government contracts, so the margins are better. Then there is the rental model, which is the OPEX model for the client. And under the rental model, typically these contracts go on for around 5 to 6 years. So last year we won a contract where we invested around this was in 2024, this was pre-IPO, where we won around, we invested around 6.5-7 crores. And we will be booking 7 crores in revenue each year for the next 5 years. We've already booked 3.5 crores in the first half year. We are going to be booking 3.5 crores in the next half year. And so from a margin profile, CCTV cameras are definitely very, very higher than our traditional business of facility management.
So currently, how are we positioned? Like, how many states are we eligible in to bid for CCTV? Is there any requirement or regulation?
So we are eligible to bid in CCTV in almost all states. So there is no regulation. It is only the limit to our installation capabilities. Like we are pretty strong in the east, so in West Bengal, Odisha, and the northeast, we have a pretty high capability of taking the contracts. In Maharashtra, our capability is evolving, and we hope to see a lot of traction coming from Maharashtra, Gujarat area over the next year. In fact, some of these could be actually be on the OPEX model, on which we are hinging a lot for our year-on-year margins.
So can we expect, like for next 1 year, can we expect a 10 to 15% rise from the CCTV revenue?
I am sure that would happen.
Okay. Thank you so much and all the best.
You are most welcome, sir.
Thank you.
you. Next question is from the line of Nimish Maheshwari from Sunrise India Growth Fund. Please go ahead.
I want to
Nimish?
understand about, hello,
Yeah, please go
Yes,
ahead.
good afternoon, sir.
good afternoon. What is coming under other non-current assets, which is, 2x from the last published number?
Sir, other non-current assets would be fixed deposits, sir, mostly.
What is inside it?
Other non-current assets, right?
Yes, other non-current assets. What is the
Yeah,
split
so
of, like, what is inside it?
Yeah. So these are fixed deposits that we have done. Earlier, these fixed deposits were against the mortgages, and right now we have done fixed deposits based on from the IPO fund.
Okay. So fixed deposit is coming under non-current assets.
Yeah.
And what is...
Yeah. The
And
fixed
what is,
deposits are coming under other non-current assets and cash and cash equivalents, both.
Both? But why, like, why both?
Sir, because the majority of the fixed deposits are short-term 6 months fixed deposits, and a very small percentage of fixed deposits are kept under long-term.
Okay, so for long term, you are going into other non-current
No, sir.
assets,
No,
right?
it's not because of that. Because we realize that in the short term, we will not be able to use all the funds. The long term were offering slightly better interest. So, but it is liquidable at any point in time.
And in non-current investment, what is that 11.5 crores?
So these are our subsidiaries, sir. Investments which were done in our subsidiaries.
Okay. Sir, in last 3 years, if we see our revenue, so there is not much substantial growth we have seen. So how you are looking for next 2 to 3 years? And, because of this CCTV shift, how much margin profile improvement we can see in next 2 to 3 years?
Sir, our growth expectations are pretty high, especially not only in the revenue area, but in the margins area also for the next 2-3 years. So there are certain changes we have already started doing, and we also expect to use our IPO funds in making these very important changes. One is, as I said earlier, sir, we are going to become more an integrated facility management and security solutions operator than standalone security or standalone cleaning contractors. This will give us a very high growth in revenue, because where we today with the same client we are possibly having revenues coming from a single vertical of security guarding or cleaning operations, etc. By an integration, we will have a much higher revenue. And since the integration usually comes with a lot of mechanization, automation, and procurement of consumable materials and rentals of machineries, we will see a significant surge in the margins in these integrated facility management contracts. So that is one area, sir, we are going to have a very high revenue. And what we are also focusing on, which we didn't do much of earlier, is that we have been focusing more or less primarily on the government contracts for these integrated facility integrated facility services, management services. But now, of course, we are looking at moving into the private sector corporate space for doing this work, and the demand for this kind of a work in facility management is increasing day by day. So this is one aspect of it which we see, which makes us see the revenue and the margins growing very high, pretty high. And then the second thing that we are looking at is our initiatives in the CCTV area. And in the CCTV area, there are few additions that we are looking at or focusing on. One of that, as I mentioned earlier, sir, is our initiatives in the AI-driven camera space. We have worked with a few startup firms, and we are working currently with some already very established AI firms, and we are seeing that the traction for such installations where the cameras are AI-driven, although we started it before the IPO almost in a pilot basis, but we see that growth in this is so high in the last few months that it should actually give us a very high revenue. And so I think at least for the next 2-3 years, we are going to see a very high margin from these operations. In some of these operations, sir, for particular type of cameras, which are very niche cameras built by startups, in which we hope to see a very high traction and margin.
Thank you.
Welcome.
Thank you. Next question is from the line of Vishwender Singh from Prudent Equity. Please go ahead.
Hi, sir. Am I audible?
Yes, sir, please. Good afternoon.
Good afternoon, sir. So I wanted to ask, what is the current order book and how much is the expected timeline for its completion?
Sir, I will advise Kanana to address this, please.
Sir, so basically, I'll just answer the question slightly differently. So, because we are in an annuity kind of a business where we kind of retain contracts on a year-on-year basis. So our order book is, so till now we have been able to retain all contracts that we had last year. Now, our turnover for the last year was consolidated turnover for the last year. So I'm for security facility management and housekeeping, our turnover was 373 crores. Or at the entire 373 crores is still with us. So we should be doing 373 crores definitely. With that, we are expecting another. We've also added around 600 odd manpower during this year. We expect to add around another 400 to 600 manpower during this year, at a very baseline level, and which should take along with minimum wage revisions. We should look at around 10 to 12% increase in the entire revenue profile.
Okay, sir. Another question I wanted to ask, like next year is election in Bengal. So are you preparing for more election-related services or contracts? So do you see that as a major growth trigger for us?
So typically, election-related contracts are very temporary in nature. So what happens is that, yes, we are expecting election-related systems integration because there is a government directive that, or the Election Commission directive that all booths have to be covered under CCTV. But there is also the slight additional risk because after the election is over, many of these cameras actually become redundant for a significant period. And so what we have already put forward to some of the governments is that instead of these contracts typically remaining within the realm of systems integration, we should rather move towards a rent model in this. And we hope we shall see some revenue coming from that in the election year, which would actually help us to improve our inventory position and also help us in getting a very good margin. We are traditionally an operator which works extensively in the events area, and we shall like to exploit this kind of an election period contract into the events area, sir.
Okay. Lastly, sir, I want to ask, what is the current share of revenue from CCTV segment, and what is your expected target to contribute it in the next 1 to 2 years?
Sir, first half it's 9 crores, and we expect it to be around 21, 22 crores by the end of the year.
And can you share the EBITDA margins for that segment, if it is possible?
Yeah, the EBITDA margin for that was around 18 to 20% on the back of the rental income that I just spoke about, which is essentially that we had made the investments in 2024, and now we have received the rental income, and there was not much cost of operations associated with it, and so our EBITDA margins had gone up, and we expect to see this sustained growth on a year-on-year basis, at least for the next 5 years.
Okay. Just wanted to add on, what is the share of CCTV in OpEx versus CapEx? You were mentioning that there are two segments in there.
Yeah.
So what is...
Exactly. So basically, looking at the fact that we do around 20 crore we've done 20 crore business last year. Just take last year full year numbers. 20 crore business last year. And in the 20 crore business last year, it was mostly, the non-rental income, the FY26 income, right, which is where the customer purchases the cameras. And but at the end of the year, we were able to book some level of, we were able to raise a very small bill that did not really impact much. But this year, if we do around 21 crores, of the 21 crores of revenue, 7 crores we will anyways book from the rental income. 3.5 we book, 3.5 will book in the second half. So 7 crores will book from the rental income. We are expecting maybe another crore or so of rental income booking. So it will be somewhere around, I think, 8 crores over 21 crores. So maybe 40%.
40% is OpEx.
40% is rental income, which is, and then 60% is the non-rental income.
Okay, sir. That was all. Thank you, sir.
Thank you, sir.
Thank you. We'll take our next question from the line of Keshav Garg from Countercyclical PMS. Please go ahead.
Sir, so what is the kind of capex that we are looking at?
So the capex is already done. It was done last year. So on this contract, we are... Sorry?
So no significant capex expected on an overall consolidated basis?
No. Okay, you are asking on a consolidated basis.
Yes.
So there is not much of a significant capex that we are looking at, except for if we get, let's say we are currently in talks with one of the private banks for a command and control center, which will require a certain level of capex. But it should be to the tune of, from the talks, what I can understand, should be to the tune of maybe 5-6 crores over 2 years. Other than that, maybe a machinery purchase of maybe 1.5 crore, because we got Fulvia docks. So that would possibly require a machinery purchase, from what I can understand. That contract has started. Then next year, if certain two other bids actually fructify, then maybe next year 2 to 3 crores of machinery. I think this is the profile of capex.
Okay. And what's our cost of borrowing? What's the interest rate we pay on our borrowings?
Yeah, so this year, I think, so after the IPO, what we've been able to do is we've been able to reduce our interest rate with SBI from 10.26% to 8.85%. And we've already given Bank of Maharashtra and ICICI Bank both a request to reduce it to 8%. So that we are expecting that will happen come around by end of this month or maybe next month. On the other hand, we have an ICRA rating ICRA rating that we do every year. So we are BBB plus company. This year we are expecting that on the back of our financials and the IPO and the liquidity, that we are expecting an A- rating. If that happens, then we are hoping to bring it down further to maybe SBI can go down up to 8%. Bank of Maharashtra and ICICI Bank being minority partners in the banking consortium, they can go down to maybe 7.5%.
Okay, that's great. So, interest outgo should also reduce in the second half as compared to the first half then? It was around 4.75 crore.
Yes. Yes. There are possibly two reasons why interest outgo should reduce. One is that we've historically been under the banking consortium, right? So, let's take SBI. SBI has given us around 39.5 crores in cash credit. Now, of that, 33 crores is actually FCNRB. So the 4 crores that you're seeing is actually has a 44 lakh loss of FCNRB, forex loss. We have already given an application to completely remove the FCNRB. What FCNRB does is that what FCNRB and any other loans which are in the nature of WCDL, which is working capital demand loans, what they do is that the interest remains fixed. So the impact of the collection does not get translated into a lower interest cost. So now what we have asked the banks is to remove all the WCDL and FCNRBs so that the collection impact can come in. And once that comes in, I think it should, this year annual interest cost, the absolute number should be less than even the last year. Because if you compare 24-25 interest cost to 23-24, you would see that there has been a crore of reduction. And that was because we gradually kept converting these WCDLs into normal cash credit. And I think we'll be able to complete that process this year.
Right. And also regarding the CCTV business, if you could give us more idea that what exactly, I mean, are we some distributor of some OEM CCTV manufacturer like CP Plus, etc., or it is just that we are buying CCTV cameras from some distributor and then installing it at the customers? Is that the business model?
So the first is that we are system integrators. A system integrator actually works on a comprehensive contract. So where the contract requires procurement of these devices, along with that a host of accessories, and after those are installed, we also do the installation. So there is a lot of labor cost involved in it, and the installation is done. And after it is installed, for a significant period, we usually maintain these contracts for a longer period. Now, that is the vanilla type of installations that we do. Right now, what we are focusing on, and we are doing more and more, are installations which also require an additional layer of AI analytics. Now, we are working with our partners in providing this AI layer. And when this becomes, it does not remain only as a installation project per se, although technically it will remain, but in a greater part, these analytics also give us a lot of other potentials. I'll give you as an example that in certain private contracts, as I said, that we have an AI device and which we are installing, we are increasing our subscription revenue from these contracts. These are yet small, but this will significantly grow because once we are installing a camera system with an AI layer, then the subscription element of that maintenance becomes significantly higher and important for the entire project. So it is not just pure purchasing and installing cameras. It is basically comprehensive projects towards a clear outcome or giving certain solutions in the security space or even in other management space.
Great. And lastly, since our major business is coming from West Bengal, so soon there are elections. So in case there is some change of government, do you anticipate any disruption in our business?
Sir, we are already working in 14 states, and over the years we have seen a shift in government in many of these states. For example, I can give you examples of Assam, I can give you example of Odisha, and I can give you example of the very recent Bihar. So in all these places, we have seen a change in the government, But due to our operating character and due to the outcome that we provide through our contracts, we have never seen a significant drop or change in the revenue because of a change in the government.
Okay.
The only
Thank
thing
you,
that may
Mr.
happen
Chaudhary.
is that older contracts may actually change in favor of some newer contracts.
Right. Thank you, Mr. Chaudhary. Best of luck.
You are welcome.
Thank you. Next question is from the line of Mayur from Tijori Finance. Please go ahead. Mayur, please go ahead with your question. Your line is unmuted. Since there is no response, we'll move on to the next question from the line of Vishwender Singh from Prudent Equity. Please go ahead.
Hi, sir. I wanted to ask, what is the employee count currently and what was it for last 2 years?
Yes.
Sir, currently sitting in currently at the employee count as on end of September, 30th September, 17,200. Last year we ended with 16,600, and the year before last we ended at 16,400.
And you said you will be adding roughly 400 to 600 more employees this year.
At a very baseline level, we should definitely be adding around the 600.
Okay, sir. Also, I wanted to ask on your previous statement on EBITDA margin increment. So what was the trigger for that? You were saying it will improve from current levels.
So this statement that I gave a little while ago on our 27 guidances and things like that?
No, somebody asked the EBITDA margin have come from 8 to 7%. So you mentioned that will improve and go back.
I mentioned that there are two significant areas where we are looking at a higher EBITDA margin. One is we are actually trying to add more integrated facility management contracts from the standalone security and housekeeping contracts. Because these integrated facility management contracts actually come with comprehensive requirements, like there are manpowers, but a significant percentage of that comes from deployment of machineries, consumable materials, and other specialized cleaning services and specialized facility services. Like it could be horticulture, it is oftentimes facade. We do very large facade cleaning and things like that. We do pest control. So with those coming in within the contracts, we shall increase the revenue and the margin on this. This was one. And the second is that with our CCTV installations, with AI-driven cameras coming in, and we are being one of the fewer service providers who can actually provide the AI-supported analytics from primarily our own or very close resources. We should also see a very significant jump in the margins in the CCTV area. That's what I said, sir.
So, sir, can it go back to our previous 8% mark for this year?
This year, 8%. 26, sir.
Sir. Yeah, next year.
Next year, 27.
Yeah,
yes,
27.
Sir.
Sorry, so what is your question for?
Can we go back to the 8%?
So, like, what is our EBITDA margin guidance for this year and next year, considering these two triggers happen in this second half?
Sir, I think this year I would say that it should remain within the range of 7.5 to 7.7%. And next year, I think we believe that these, the improvements that we've made, it should come into play, and it should improve the EBITDA margin to about 8%.
Okay.
Near about
Thank
8%.
you. Okay. Thank you, sir.
Thank you.
Welcome, sir.
Take our next question from the line of Mayank Saraf, an HNI investor. Please go ahead.
Yeah, I had another question and a suggestion as well. Since we got listed in September, and right now you said we won some tenders last month and this month as well. So kindly please notify the exchange so that the investors can read about it.
Yes,
Sure, sir.
we shall do that.
We will do that. We basically waiting for larger contract to kind of roll in, but definitely whenever we get a new
Significant government contracts and everything, we shall definitely upload.
Thank you. And one more thing I just wanted to clarify, like we were talking for some tax benefit of 80J or something like that.
Yes, sir.
Of 3-4 crores of bottom line being added. So this is for FY26 if I'm right.
FY26, yes, sir.
So that will get added to the bottom line, like 3 or 4 crores.
Sir, what we've seen is that in 24-25, despite the tax actually going down significantly, it did not translate into a bottom line addition.
Okay. Got it.
Yeah.
Thank you.
Thank you.
Thank you. Next question is from the line of Madhur Rathi from Countercyclical Investments. Please go ahead.
Sir, thank you for the opportunity. Sir, the 7 crore rental income that we are expecting from the CCTV rental business, so is it fair to assume that majority of this will flow to our EBITDA? So can we expect 80-90% EBITDA margin on the 7 crore revenue?
Sir, there are two things. It's not just, that's not the only contract. Because we also, like I said, we have around 60%. If we do around 20-21 crores in CCTV business this year, there is going to be the SITC part also, which is the supply, installation, testing and commissioning part. Now, assuming that now all contracts don't end by March. So because of that, but we will have to purchase the cameras and everything. So while we have seen that there has been a spurt at the EBITDA level in the mid-year, I would not place that figure at the end of the year. I think I would still go with 20% EBITDA margin is what my 20-25% EBITDA margin overall for the CCTV business.
Right. So I'm just asking about the rental aspect of the business. So on that 7 to 8 crore revenue that will generate, majority should flow to our EBITDA. Is that understanding correct?
No, that understanding is perfect. Yes. Yes.
So on basis of that, sir, we made 16 crores EBITDA during H1. So our margins have even further reduced to 6% in H1 when considering that if I exclude the 3-4 crore revenue and 2-3 crores of margin, also so our EBITDA is actually 13 crores on a 210 crore revenue. So if you could just help us understand that why is that?
There has been an improvement because if you see comparing to the EBITDA margin at a consolidated level was 7.79% in the first half. In the second half of the last year, it was 7.27%. So there has been an improvement at the EBITDA level.
Right, but sir, if I'm looking at only the core business, that the facility management, the integrated, all kind of contracts that we have currently, and I reduce the whatever rental income that we received, the 3-4 crores during H1. So then our margins, then our EBITDA is only 13 crores and our margin is only 6.1%. So I'm trying to understand on that. So from 7.2% it has reduced to 6.1%.
No, there was, like I said, majority of the amount will get converted, but not all. There is going to be around there has been roughly, if I'm not wrong, 1 crore of rupees in terms of maintaining of the contract. So the entire EBITDA, the entire rental income will not get converted because you see CCTV cameras will also have to be replaced. So there are costs associated with that.
Right. And so currently, we only have this, how big is the CCTV CapEx model contract that we have, and how much contract are we bidding for?
Sir, first, so currently we have that one contract, which is with the Government of West Bengal Food and Supply Department, and that is for 5 years. So that's 7 crores into 5. Other than that, they have also given us an enhancement of, I mean, we bid for the enhancement of another 100 warehouses. So that we should be, because we are an existing service provider, we obviously have an upper hand in the bidding process in terms of getting the contract being an existing service provider. So that should be another 10 crores, but I mean 2 crores into 5. 2 crores annual revenue into 5. Other than that, there is one in the private sector with one private bank. We are discussing a command and control center, which would also be in a rental model, but I think that would eventually convert in 25-26.
20.
Sorry, 26-27.
Got it. So that was from my end. So thank you so much and all the best.
Thank you.
Thank you. Ladies and gentlemen, we'll take that as the last question for today. I now hand the conference over to management for closing comments. Over to you.
Thank you very much for being here and for participating in this detailed manner. It also gives us a lot of clarity and an inspiration to go forward. And I look forward to meeting you again and coming back with more encouraging, equally and more encouraging figures. Till then, I will sign off from here along with Kanaz, our CFO.
Thank you, sir. On behalf of NIS Management Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.